Welcome to the first monthly market update video of 2025. I'm Tyson Romanick, Senior Portfolio Manager here at Baker Boyer, and I'm joined with John Cunnison, CIO, and we're going to talk about the year ahead.
Great to be here. Looking forward to it.
So when you guys received your last month's monthly market update video via email, there was a link at the bottom, and that allowed you to submit a question. And we highly encourage all of you to please submit any questions or comments that you might have, because if you have a question, odds are someone else does too. So we will try and answer as many as we can during each one of these monthly videos. So with that, John, we're in a new year. What do we see ahead?
Well, I guess my first prediction will be that forecasting continues to be extremely difficult, especially about the future. So there's my joke for the month. Seriously, one of my big predictions will be people that ignore all of the typical beginning of the new year market forecasts will be well served by ignoring them. It's just difficult. So because we can't predict the future, we need to prepare. You'll talk a lot about that today when we talk about sort of how do we invest in these difficult times. But if we turn our attention to just the questions that we're getting from clients, I think I'm seeing two that are most frequent, and it's fascinating because they're so related. The first one is, how do I get in on this AI revolution? How do I buy AI stocks? We're getting that question quite a bit. The other question, which is actually the opposite, is how do I sell stocks? Should we be selling stocks? And basically making ourselves safer. I feel like stock prices are high. I keep hearing about all these fancy new things like cryptocurrencies, and it's making me very nervous. It's just a fascinating time period that we're in.
Yeah. Well, I mean, to me, that kind of sounds like, you got a little bit of a bubble people are worried about. You have some euphoric people, you have some people who are worried. Now, you just read an interesting book that kind of dives into that. Maybe you learned some good insights on that.
Yeah. The book that I read was called Boom. And for anyone out there who wants to dive more deeply into sort of the idea of booms in the economy or the stock market and sort of some of the outcomes, it's a fascinating book, and I highly, highly recommend it. The gist of it, for those of you who don't want to sort of go through 300 pages of this kind of a thing, the gist of it was that there are good and bad booms or good and bad bubbles. Right? Some bubbles are just repackaging of old ideas, and they leave, when the bubble pops, right, they leave us with not a lot. A great example of that would be 2008. So that was a time when we kind of repackaged mortgages into mortgage-backed securities, and it came along with all sorts of other problems. And it left us with, a troubled economy, a housing market that was in, free fall. A lot of people hurt badly, and nothing came of it. The flip side to that, though, is a lot of these sort of booms or bubbles attract investment into really interesting ideas. The tech bubble and bust back in the turn of the century, so 2000, that was an interesting one. There were a lot of companies that didn't survive it, but that didn't make the underlying ideas bad, right? So we are with the internet. Right? It's changed the way we live, right? Everyone here is watching this video over a computer that at the time was just not something that we could do. So it revolutionized, digital exchanges of information, right? And that was all due to, or in part due to a bubble that attracted capital. Where do we find ourselves today? Well, with AI, the question is this a good or a bad boom or a good or a bad bubble, right? And the answer is that it's highly likely that AI is the real deal, right? That there's a lot of really interesting technological advances that are bound up in AI. Where we spend a lot of our time, of course, is convincing the people who are euphoric about some new idea to temper their enthusiasm somewhat, with the idea that a lot of those ideas, right, or I guess I should say, the excitement we should feel about those ideas is already in market prices, right? Those prices have elevated quite a bit. Now, for the people who are despondent and they're saying, I want to get out of stocks, this is all making me very, very nervous. I think to them, I would say also temper your pessimism in some ways, because over the long haul, stocks have generated value. And a lot of the elevated prices that we're seeing are concentrated in a few stocks. I think you'll talk about that in sort of how we invest. And if you just look at this chart, I think this chart does a really good job of showing us that just because we've hit a market high, it doesn't mean that we're headed toward a cliff, right? Just because we hit a mountain peak, it doesn't mean there's a cliff on the other side. Right? The stock market tends to go up over time. So market highs are a very natural part of the stock market, and we'll experience hundreds of them over the course of time. What this chart shows us is that during months, going back to 1926, if we just take all the months, which is about 30% of all the months since 1926, we look at all the months where we ended at a market high, what was the subsequent 1-year return, 3-year return, and 5-year return? And what we can see in this chart is it's normal. In fact, over 1 year, it's actually higher. Right. So the bottom line to that is, if you're investing at a market high, right, you should expect that there'll be other market highs, right? So it's not something we should be really terrified about. So if you are really excited about AI, you're euphoric, temper your enthusiasm. And if you're despondent and pessimistic, I would say equally, temper your pessimism somewhat, and you'll be well served. The other big question that we're hearing is around inflation. And inflation is, I don't have any answers. I'm not going to tell you that I know what's going to happen with inflation. What we can say is that, things are looking a bit stickier. You mentioned this morning, as we were discussing inflation, that it's very rare for the Federal Reserve to decrease interest rates and have the long end of the long bonds or long interest rates go up. And those longer-term interest rates are an indication of what the market feels about future inflation.
Right. Yeah, it's been 40 years since that happened last. And we just saw that happen the last time they dropped rates.
Which indicates that at least a lot of investors are expecting maybe higher rates of inflation in the future. Will they be right? Well, we don't know. But I think the bottom line is that, again, we can't predict, so we prepare. We've got to build some inflation protection into portfolios. The last thing I'll say on that, and then maybe you can tell us a little bit about how we might think about investing in this environment. But the last thing I'll say about inflation is a really, I don't want to overstate it, but I'll call it a pernicious evil in investing, because you're talking about the only return that matters in investing is the return above inflation, right? And so the higher inflation is, the more difficult it is to achieve the long-term rates of return that make our financial plans work. So we have to think about inflation very carefully when we invest, and we have to build in protections. With that, with all I just said and all this going on in 25, how do we invest in this environment?
Well, yeah, that's a lot to cover. But I'll start off first going over AI. Is AI the next internet? It's very possible. Some say it might even be bigger. So how do we ensure we're capturing those companies, those transformative companies that are going to benefit from the next, AI boom, maybe bubble? And how do we do that? Well, the first approach, I guess, and one that's kind of the main approach we take is we start off using market cap weight. And so this naturally prioritizes the biggest companies, which are those companies that have benefited so far from AI, the Amazons, the Googles, the Microsofts, the NVIDIAs. And so we do tilt a little bit more towards value, but we start off with those market cap weightings. So even though we have a value tilt, our clients' portfolios, the biggest holdings in their portfolios are still those companies that I just named. We just own them in a little slightly less, proportion than the general market.
market cap weighting just simply means that we own our biggest holdings are the largest companies.
Yes.
So,
But we own all of the companies.
but we own them all.
Yeah. Now, for those of you who, maybe want to find the next Google, NVIDIA, that's really hard to do. How do you find, going back to the last tech boom, how do you find the next Google but not the next Netscape? That is really hard to do, but, we do have a way to do that. Somewhat, we have the Morgan Stanley Growth Fund in a lot of our clients' portfolios. And that's a very, technology-heavy growth fund that kind of tries to find those cutting-edge companies that still make a profit, but are kind of in the area where those kind of new and upcoming AI companies could come from. So we do also own that in a lot of our portfolios. Now, on the other side of the coin, we have those people that are worried about, maybe a boom and a bust or a bubble. And so how we address that is, as I mentioned a little bit earlier, we tilt a little bit more towards value. So what does that mean is when companies get expensive, we'll trim a little bit of that and buy cheaper companies. And so that kind of lessens our exposure to those companies that have really high valuations. On top of that, it might be time for a rebalance. We're looking at rebalancing our portfolio, maybe trimming a little bit of those U.S. companies that have, had quite the run, and buy some of those other areas that have a lot more attractive valuations, like bonds maybe, or value companies or international companies. And so that's another thing we're gonna look into.
I think it's important to note here that it's not necessarily a method for timing the market,
right?
But just a systematic thing that you do in portfolios to maintain your exposure to risk. And part of what we do is to make sure that people's risk tolerance is represented in their portfolios.
Right.
So bring them back to that target level of risk.
Exactly. Right. Now, the last thing I guess I'll address is the inflation question. Now, on this chart, you can see there's basically two axes. There's the horizontal, which is economic growth. On the right side, there's high economic growth. On the left side, there's falling economic growth. And then on the vertical axes, there's inflation. And so the top part is high inflation, and the bottom part is falling inflation. And so if you kind of look at the top half, each quadrant shows, what kind of investments work well in those environments. And so in the high inflationary, which is the top half of the graph, usually commodities, things like gold, do really well. And if you remember, probably 2 years ago, we added the Cohen & Steers Real Asset Fund.
Right.
And that owns those commodities. It owns gold and things like that protect against high inflation. And then on top of that, the one thing you can see on there that you don't want to be on, kind of on the bottom half, is bonds. You want to be, especially in treasuries, in a falling inflationary environment. And so kind of what we've done, as we've had dividends and interest, and we've had cash build up in our portfolios, that acts as kind of a shortening the duration of our bonds, and that helps protect in inflationary environments. And so we've held cash, and then also our portfolio managers have, for our bond funds, have also shortened their duration, and that's also been protectionary against higher inflation.
And just to put a point on that, reducing duration, that's a fancy way to say we're reducing the sensitivity of our bond prices to interest rates.
Right.
So if inflation is higher, interest rates are likely to go up. Mm-hmm. That makes bond prices fall. Mm-hmm. But if we reduce our duration, if we hold shorter bonds, our prices won't fall as much in an inflationary environment. We'll protect against inflation.
Right. So in conclusion, our strategy ensures that we will benefit, from the AI environment, these newer technologies. But not only that, we also have protection against a bubble, also against high inflationary environments.
Mm-hmm. And like any new technology, AI comes with its risks to society generally. But from an investing standpoint, it's a very exciting new technology. We just have to be, from an investing standpoint, we have to be fairly measured about how we approach it.
Right.
Yeah. Well, thank you for joining us today. We truly appreciate it. If you have any questions, again, or comments, good or bad, we want them all. Put them in that link at the bottom of the email where it says Ask an Expert, and we'll be sure to touch on those at all of our monthly market updates. And with that, thank you for joining us today, and good investing.